Okay, today we are going to start capital budgeting or investment appraisal review, or in fact, we will discuss all the important aspects. Now, what is this capital budgeting? What is investment appraisal? Capital budgeting or investment appraisal is the one where we are going to make a plan for the next certain number of years. Basically, capital budgeting or investment appraisal is the one where a company is planning to launch a new product in the new market, or company is planning to start a new project, or company is planning to expand its business operation. So this is called what? This is called capital budgeting or investment appraisal. Capital budgeting or investment appraisal is the one where an organization is planning to launch a new product, or planning to start a new project, or planning to expand its business operations. Now, another important thing is whenever a company is making long-term plans or making investment appraisal or capital budgeting, it is usually more than 3 years, like for 5 years, for 7 years, or for 10 years, or maybe for more than 10 years. Capital budgeting or investment appraisal are based on cash flows. This is very important to understand a basic thing. It does not include any kind of non-cash items. It does not entertain depreciation. It does not entertain amortization or any other item. Cash flow is basically the one which is used to calculate the net present value. Capital budgeting or investment appraisal is based on the concept of capital budgeting process. What is this capital budgeting process? Capital budgeting process means a company will evaluate when to accept the project or how to accept the project. Whenever you are evaluating your long-term project, or you are analyzing or performing capital budgeting process, first of all, you will evaluate available investment opportunities. Available investment opportunities. How many opportunities you have right now? After having available investment opportunities, evaluate investment opportunities. Now you will evaluate investment opportunities on the basis of what? On the basis of payback period, on the basis of accounting rate of return, on the basis of net present value, on the basis of internal rate of return. Evaluate investment opportunities. Then after evaluation, you will choose best project. Best project does not mean the one you choose is the best one. Best means the one which is chosen by you or picked by you is best in available your circumstances, with respect to available level of investment, with respect to available level of human resource, with respect to skills of the human resource. So best is, or the one which is fit in your strategic plans or fit with your long-term plans. Next one is make investment decision. Now you will make the investment decision. Then after making investment decision, then there will be monitoring and control. We will monitor either we are achieving the required objectives from our investment or not. Then feedback. Feedback is called what? Performance measurement, where we are measuring the performance, what we set the target and what we achieved actually. And then we have feed forward. Feed forward means making future plans on the basis of past results. So this whole is called what? This whole is called capital budgeting process, which starts from available investment opportunities till feed forward. This is the basics of the investment appraisal. After that, we will discuss investment evaluation techniques. Whenever we want to make investment for long period of time, now what are the techniques? For example, number one is payback method. Payback period or payback method basically calculates how long an organization is needed to recover its initial investment. How long is needed to recover initial investment? How much time is needed to recover initial investment? There are two different types of payback period. One is called simple payback period, or you can only use the word of payback period. And the other one is called discounted payback period, which is based on present values. Now, what is the difference between two? For example, I am going to assume in data, making a column years, net cash flows, and the third column is cumulative cash flows. Year 0, 1, 2, 3, 4, 5. Suppose initial investment is $700,000 and cumulative cash flow is same $700,000. In year 1, suppose we earn $200,000 and cumulative cash flow is now negative $500,000. Then suppose at the end of year 2, we recovered or we earned further 240,000. So still there is recoverable 260,000. I hope you understand that out of 700 negative, we have earned this 200,000 positive. So that's why now we have negative 500,000. Further, we have earned 240,000 out of this 500, we have 260,000. Then suppose next we earn 250,000. Still there is negative 10,000. And in the next year, company earned 260,000. So now it has positive balance of 250,000 at the end of year 4. Although there is a cash flow of like 280,000, or I would say like 200,000. 200,000 at the end of year 5, but We have recovered our investment in year 4, so that's why there is no need to calculate the working in year 5. Now we will calculate payback period. How to calculate the payback period? Basically, in year 1, we have cumulative cash flow as negative. We have negative cash flow in year 2. We have negative cumulative cash flow in year 3 or at the end of year 3. So these are called what? These are called negative years. Do not treat or do not consider year 0, 700,000 as the relevant value. We have negative years, first 3 years as the negative years. So we will calculate payback period is equal to negative years are 3 plus last negative cumulative cash flow. This is the last negative cumulative cash flow 10,000. After this, now we have positive cumulative cash flow. So the last negative cumulative cash flow was 10,000 divided by next net positive net cash flow, because last negative was cumulative cash flow was 10,000, or the last negative cumulative cash flow was 10,000, which has been recovered in year 4 when we have positive net cash flow of 260,000. So now calculate payback period 3 plus 10,000 divided by 260,000. 10,000 divided by 260,000. It is 0.0384. So 3.0384 years. Okay, so the payback period is what? Payback period is 3.0384 years. This is 0.0384 years. This is not 3 years and 0.0384 months. Most of the students make confusion and they think that it is 3 years and 0.0384 months. It is not 0.0384 months. If you want to convert this decimal into months, then multiply it with the 12, and now you can calculate months. So now we have 3 years and 0.46 months, means not even the half of the month or not even 15 days. So this is simple payback period. Anyone, any question? No question? Okay. Now we will calculate the second one, discounted payback period. Discounted payback period is basically considered as more reliable in comparison with the simple payback period. Or we can say that discounted payback period use present value of cash flows, or it calculates time value of money. That's why discounted payback period is considered as more reliable than the simple payback period. Remember one more thing, discounted payback period is always greater than the simple payback period. Why? Because it is using present value of cash flows. So that's why it is always greater than what? It is always greater than the simple payback period. So now what will we do? We will keep this column as it is years. Then we have net cash flows. Then we have present value at 10%. For now, how to calculate present value? Present value factors are provided in your exam kit. In BPP exam kit, I think it is provided at the end. And in Kaplan exam kit, I think it is provided at the start. So we will use present value factors. For year 0, present value factor is always 1 at 10%. For year 1, 0.909, then we have 0.826, then we have 0.751, then we have 0.683, and then we have 0.621. So now we will calculate present values first, and then we will calculate cumulative cash flows, and then we can calculate payback period. For year 0, present value remains the same, 700,000 negative. For year 1, 200,000 into 0.909, 181,800. Basically, these are present value factors or discount factors. These present value factors or discount factors are provided in the exam kit, and it will be provided in the actual examination. If you have BPP exam kit, I think at the end of the BPP exam kit, you can find present value table, and you will be able to see these present value factors at 10%. If you have Kaplan exam kit, then you will be able to see almost at 10th or 11th page these present value factors. And to convert cash flows into present values, we will multiply our nominal cash flows with the present value factors. Next one is 240,000 into 0.826, like it is 198,240. Then the third one is 250,000 into 0.751. It is 187,750. Then 260,000 into 0.683, 177,580. Then 200,000 into 0.621, 124,200. Then we have cumulative cash flows. For year 0, we have 700,000 negative. We have recovered 181,800 out of 700,000. So we still have 518,200. We have further recovered 198,240. So we have 319,960. We have further recovered 187,750. So we still have 132,210. We have further recovered 177,580. So now we have positive balance of 45,370. What does it mean? It means in year 4 we are in profit. Once again, there is no need to calculate the cumulative cash flow for year 5. And once again, first 3 years will be considered as the negative years. But definitely, this time your answer will not be 3 years and 0.46 months. This time your answer will be more than the 0.46 months. For example, here we assume that we have negative years of 3 plus last negative cumulative cash flow 132,210 divided by Next, positive net cash flow 177,580. So you can calculate your payback period. It is 3.744 years. One of the candidates is asking a question. In exam, should we ignore any cash flows after we have? Yes, definitely. I am teaching you the one which is needed in the exams. When you have recovered your investment, payback period does not want you to calculate further calculations, right? 3.744 years. Once again, if you want to convert into months, you can multiply your decimal years into 12 or by 12. So you can say 3 years and 8.9 months. This is the discounted payback period. As I told you that discounted payback period is always greater than what? Discounted payback period is always greater than simple payback period. So this is the concept of the payback period. The another concept, the second concept is called what? ARR or accounting rate of return. ARR or accounting rate of return basically calculates return on capital employed, what we invested and what we recovered or earned. So ARR or return on capital employed is equal to average profit per year divided by average investment into 100. Now how to calculate average profit? Average profit per year is equal to total profits divided by total number of years. Next one is average investment is equal to initial investment plus scrap value divided by 2 to calculate the average. Now we need what? Now we need profit. Now what is the difference between cash flow and the profit? Now we are continuing with the same example or with the same data, but we need to calculate depreciation per year first, then we can determine profit. So now what we will do, we will calculate our depreciation per year on the basis of straight line basis. So depreciation per year is equal to initial investment is 700,000. Currently we have no scrap value, so we assume that scrap value is 0. Divided by useful life is 5 years. So you can calculate your depreciation on straight line basis of 140,000. So now we will deduct depreciation from the net cash flows to calculate the profit. And when you are determining accounting rate of return, there is no need of year 0. We just need data from year 1 till the last year of the project. So 200,000 minus 140,000 is equal to 60,000. 240,000 minus 140,000 is equal to 100,000. Then 140,000 is equal to 110,000. Then 140 is equal to 120,000. Then 140,000 is equal to 60,000. So these are the profits for each year. Now we will follow the formulas. First formula says that calculate average profit per year, where total profit is divided by total number of years. So we have 5 profits. We will add up all these values. 60,000 plus 100,000 plus 110,000 plus 120,000 plus 60,000. 450,000 is the total profit. So what is average profit per year? We can calculate 450,000 divided by 5 years. We have $90,000 per year as what? As the average profit per year. Second, we will calculate average investment. Here we have an investment of 700,000 plus scrap value is 0 divided by 2. So the 350,000 is what? 350,000 is average investment. Now we will calculate ARR or accounting rate of return. Average profit per year 90,000 divided by 350,000 and 200. So 90,000 divided by 350,000 and 200. 25.71% is accounting rate of return or return on capital employed. Right? Understood everyone? Any question? Okay. Third concept is very important concept is net present value. Basically, when you are calculating net present value, there are number of information or data is provided. When you are calculating net present value, you need to take care which one of the costs are relevant costs and which one are the irrelevant costs. Relevant costs are those which are directly related with our investment decision, and irrelevant costs are those which are not related with our investment decision. Now, first of all, you need to know the relevant cost, and the order which am I following right now is the order in which you will solve the questions. Number one, always should start from initial investment. Initial investment is also known as capital expenditure. Initial investment or capital expenditure is incurred in year 0, and it is what? It is a cash outflow. The second one is sales revenue. Sales revenue always starts from year 1 till last year. Second thing is it is a cash inflow or relevant cash inflow. Now, third very important thing is suppose question says you that selling price per unit is $10 in current price terms. Whenever question uses the word of current price terms, it means it is called year 0. Current price terms or year 0 is the one where we are calculating or where we will incorporate inflation from the next year or inflation from the first year. So in year 1, suppose inflation percentage provided in the question is 5%. So 10 into 1.05 raised to power 1. Raised to power 1 is used for year 1 if selling price is provided in the current price terms. Suppose we have 10,000 units. For year 2, $10 into 1.05 raised to power 2 into 9,000 units. Suppose if we have 9,000 units for year 2 and so on. For every year we will use raised to power 3, 4, 5 and so on. But at times question says that suppose selling price per unit is $10 in first year terms. Whenever it is provided in the first year terms, it means now inflation will start from the second year. For year 1, you will say 10 into 10,000 units. No incorporation of inflation because it is provided in year 1 terms. For year 2, you will say 10 into 1.05 raised to power 1. Now most of the students says that why raised to power 1 when it is year 2? Because inflation is applicable for the first time. Although it is the second year of the project, but inflation is applicable for the first time. That's why you will use raised to power 1 into 9,000 units. For year 3, 10 into now inflation is applicable on it for the second time, so raised to power 2 into 8,500. So this is the way to calculate what? This is the way to calculate inflation or to incorporate inflation when you are determining the sales revenue. These two are very technical points and you need to take care in the actual exams where most of the students makes mistake even they are well prepared with the topic. After incorporation of sales revenue, third relevant cash flow is variable cost, and variable cost is relevant cash outflow because it is the expense. And once again, for variable cost, you need to take care of these two things. Suppose he says you variable cost is $4 in current price terms. It means this time variable cost is provided in year 0 terms and you are expected to incorporate like what inflation in it from the year 1. And if he says variable cost $4 in year 1 terms, now inflation is applicable from the second year just like this. But raised to power 1 for the second year, raised to power 2 for the third year, and so on. Fourth relevant cash outflow is incremental fixed cost. Incremental or specific fixed overheads. General or absorbed fixed overheads are treated as irrelevant cost. So suppose incremental fixed overheads are $30,000 per year. If he says per year and nothing else, it means no inflation is applicable. Simply use this. Or 30,000 in current price terms, then apply inflation from the year 1, or 30,000 in year 1 terms Then apply inflation from the second year. After deducting variable and incremental fixed overheads from the revenue, now you have before tax cash flows. Before tax cash flow is basically the net answer. Then we have tax on cash flows. Tax is basically what? Relevant cash outflow. Again, there are three aspects which needs to be understood with respect to actual question. At times, question says that before requirement, ignore taxation. Ignore taxation means no tax is provided in the question, so there is no need to calculate. You are free from this calculation. Otherwise, most of the time question says tax is paid 1 year in arrears. Now what does it mean? It means tax for the year 1 is payable in year 2. Tax for the year 2 is payable in year 3. Tax for the year 3 is payable in year 4. Tax for the year 4 is payable in year 5, and so on. And so on. Right? Third one is tax is paid in same year. So this is called what? This is called tax working. So after adjustment of the tax, you have after tax cash flows. After tax cash flows again is a net answer. From before tax cash flows, you have deducted this amount, whatever the amount is. Then we have after tax cash flows, and then we will make another adjustment, which is again very important, working capital. Working capital is the amount which is called difference between current assets and current liabilities. But here in investment appraisal, a few things which you need to understand about working capital. Number one, working capital is invested in year zero or invested in advance or invested in advance. What does it mean? We will invest in year one for year two. We will invest in year three, in year two for year three, and so on. And the whole working capital and the whole working capital is recoverable in the last year of the project. When it is recoverable in the last year of the project, it means working capital has two different treatments. One is what? From year zero till second last year of the project, it is treated as cash outflow from year zero till the second last year of the project. But when it is recovered in the last year of the project, it will be treated as relevant cash inflow. So this is the treatment of the working capital. These are the different treatments. Apart from this, we have scrap value of machinery, scrap value at the end of project, and scrap value is treated as relevant cash inflow. So these are the figures related to investment appraisal. But apart from these figures, there is a very important working which is called present value of tax saving on capital allowance. In our study text and exam kits and in past papers answers, present value of capital allowance or capital allowance is also the part of this overall working which I showed here from the step number 1 till the step number 9. But I will suggest you to perform present value of tax saving on capital allowance or present value of tax saving on written down allowance as a separate working. I will share my question videos with you where you will be able to see that data or columns are prepared. Years, we have written down value, we have capital allowance. Usually it is 25% on the reducing balance or at times it is available on the straight line basis, just like straight line depreciation. Then we have tax saving. In your study text or exam kit, they prepare these 4 columns in the workings and then incorporate this value of tax saving in the main investment appraisal. But I will suggest, and I always suggest the student, use present value. Whatever the percentage is given, suppose 10% is given, so the present value at 10%. So here we will calculate present value of 10%. This is called what? This is called present value of tax saving on capital allowance. So whenever you are concluding your answer, you will calculate net present value, which is sum of present value of cash flows. Present value of cash flows means what? From year 1 till last year, all the present values, plus separately calculate present value of scrap and then separately add present value of this tax saving working. Separate workings will help you to maximize your marks if you make any mistake in the any part of the question. So that's why I'm suggesting to calculate present value of scrap separately, present value of tax saving on capital allowance separately. Otherwise, you will see in your study text examples or in your exam kit answers that they are making scrap value and tax saving on capital allowance part of the investment appraisal, but I always suggest the students do not make it part, do separate calculations and try to maximize your marks if you make any mistake anywhere. And the minus is initial investment, which is called capital expenditure or which is incurred in year 0. So this whole is called what? This whole is called net present value. Right, everyone? Okay. What next we have? Next we have is internal rate of return. Again, a very important thing, internal rate of return, a very important concept. It is also called IRR. It has different aspects in our long-term project. IRR basically the one where net present value will be zero. And the second important thing is IRR must be greater than the cost of capital or discount rate. If it is greater than the cost of capital or discount rate, then we can say project is profitable, and then we will say that we should make investment. So this is called what? This is called IRR. IRR measures basically what? IRR measures sensitivity of cost of capital. Sensitivity of cost of capital. What does it mean? It means your cost of capital is 10%, and if your IRR is 12% or 13%, it shows that your cost of capital is not significantly less than the IRR. Or we can alternatively say that IRR is not significantly greater than the cost of capital. Although there is no hard and fast rule or there is no concept which suggests us that this must be your difference between cost of capital and the discount rate, but it is not the one which is but it is not the one which is acceptable. There it must be reasonably greater than this. What does it mean must be reasonably greater? Like IRR must be 15% if we have cost of capital of 10%, or I would say at least 14%. Why? Because if even if it is 14%, we can say that it is 40% higher than the cost of capital. It shows that it is moderate risky or moderate sensitive. But on the other hand, as I told you that it looks that it is risky. This difference shows it is risky. Similarly, if IRR is 20% and you are making investment at 10%, it shows no risky. What does it mean? It means you are not availing all the opportunities. Similarly, here you are not you are exposing yourself and taking unnecessary risk. So both the approaches are not recommended. Recommended is that there must be reasonable difference between the cost of capital and the discount rate, which is called moderate, because moderate will help to maximize shareholders' wealth without taking unnecessary risk. Maximize shareholders' wealth without taking unnecessary risk. So this is called what? This is called the concept of IRR. Now, how to calculate IRR? Basically, to calculate IRR, we need two discount rates, or alternatively, we can say two cost of capitals. Similarly, we need two net present values. Without having two cost of capitals or two net present values, you cannot calculate IRR. Now suppose if your cost of capital is 10% and your NPV is positive, next cost of capital must be higher than this 10%. Next cost of capital must be like 20%, 15%, 18%, whatever. And your NPV ideally must be negative, but even if it is positive at the next cost of capital, we can calculate IRR. But suppose if cost of capital is 10%, where net present value is negative, then the next cost of capital must be lower, like 2%, and here ideally you should have positive NPV. But still, if you have negative NPV at 2%, then you should abandon the project. It means this project is not financially worthwhile. So we need two cost of capitals and two net present values. Then we have IRR formula is equal to lower discount rate plus highest NPV. Highest NPV is always at the lower discount rate divided by highest NPV minus lowest NPV into difference between high and low discount rate. High and low discount rate. This is IRR. Now we have another discussion in the IRR which is called mutually exclusive projects. Basically, it is relevant with IRR and NPV both. What is meant by mutually exclusive projects? Mutually exclusive projects are the one which we cannot perform together. We have to choose one of the projects. And remember one thing, whenever you are going to choose project either on the basis of NPV or IRR, your decision rule is always NPV. Your decision rule is always what? Your decision rule is always net present value. Suppose we have projects, then we have investment, then we have net present value and IRR. We have two projects. Investment is 700,000. Here we have investment of 900,000 and I would say cost of capital. NPV is suppose 300,000 at 7% cost of capital. Here we have NPV of 400,000 at 8% cost of capital. IRR is here 8.5% and here IRR is 10.5%. Here IRR is 10.5% and here we have 8.5%. Or I will suggest that rather 8.5, 9%. 9%. Now on the we cannot perform project A and B together. Even if we have totals 1.6 million in our cash as a cash surplus, or we can arrange from the bank, but we cannot make investment because These two projects are mutually exclusive. We have to choose the one. If we look at cost of capital and IRR, here we have reasonable difference of 3.5%. And on the basis of IRR, we can say that this project is less risky. So we should make investment in this project, because the other project where there is only just 1% difference between cost of capital and IRR, and this project is more risky. If a project is more risky, where there is high risk, there is high return, so its NPV is also higher. And decision rule is neither the IRR and nor the less risky. Decision rule is always the highest NPV. If you have highest NPV in a project, you will go for investment in that particular project, even there is a slight difference between the cost of capital and the IRR. So your 400,000 highest NPV is one that on the basis we will choose the project. So this is called what? This is called mutually exclusive projects. Right, everyone? Any question related to mutually exclusive projects? Okay. Then we have another concept related to IRR. It is called multiple IRR problems. What is this multiple IRR problems? Under the normal circumstances, we have years 1, 2, 3, 4, 5. We have net cash flow or after tax cash flow of suppose 300,000 positive, then 330,000, then 350,000, even 200,000 but still positive, 240,000 but still positive. So it is called what? It is called consistent cash flows. Consistent cash flows. You are going to make investment on consistent basis, or you are going to earn cash flows on consistent basis. These are positive. Consistent cash flows means what? Positive from year 1 till last year. Second one is years 1, 2, 3, 4, 5 net cash flows. Suppose in year 1 we have 300,000 positive. Now we have 200,000 negative. Then we have 130,000 positive. Then we have 120,000 negative. Then we have 10,000 negative. And suppose here we have 300,000 positive again. So now cash flows are basically what? Now cash flows are basically inconsistent. These are called what? Inconsistent cash flows. Inconsistent cash flows. So in case of this inconsistent cash flows, we will do what? We will say that there will be different IRR at the end of each year. So where you have inconsistent cash flows, different IRRs in each year. So this is called what? This is called multiple IRR problem. Right, everyone? Any question?